Welcome everyone, and to the finale. And it will truly be a finale where we have two amazing investment professionals, Prashant and as Ashish just recently introduced, Ramesh, who's taking over as the CIO for the asset management mutual fund business at White Oak Capital. We've had three very different discussion points around here. A lot of times, loosely people talk about India premium multiple, but I guess there's a framework which White Oak has put together, which is available in a document which we released today called Vantage Point. It's available for download, as in the resources you would find here, but you would also find it on our social media platforms. So please do go through that to give a certain idea of what this whole India premium multiple is. It's also important, considering that White Oak has been one of the largest foreign portfolio investors over the last 4 or 5 years. We have been able to talk about this India premium multiple to many of the institutions who have invested with us, as Prashant did indicate in the constitution of the type of inflows which White Oak has received over the last few years. With this, I'm coming to this module, which actually talks through the outlook for 2022, and in a way also weaves in some of the questions which you may have for both Ramesh and Prashant out here. Please do ping in those questions out there in the Q&A box which is there. So Prashant, starting with the first thing which is there on a lot of people's mind right now, we have been seeing some amount of correction on the basis of news which is flowing in from US. Indian markets have also taken some sort of a breather right now. There are a lot of pundits who've spoken about finally that elusive deep correction coming through right now. We've read a few of those reports. How do you see tapering, and how do you see some of these initial trends of 2022? There have been 2 great years of 30% plus returns, as you showed in the performance numbers. Are these type of things? I know we don't take macro views, we don't talk on top-down markets, but I guess some sort of understanding around how investors should look at 2022 would be a very useful guidance. I think Prashant, you're on mute.
Thank you, Prateek, and thank you to the audience, clients in the audience who posed this question. So I think most of the people in the audience would have heard our views on this subject. It is a perennial subject. Almost every day, this question is relevant, has been relevant for each of the last 4.5 years here at White Oak, and prior to that for the last many years or decades of mine in the industry. The reality is there is no answer to this question. People do cook up answers either well thought out or on the fly. Both are equally good or bad. As we've always said, trying to predict what is going to happen in the market is no different from trying to predict a coin flip. You may be right 100%, you may be wrong 100% in the near term. Over the long term, though, we have very strong views about what to expect from the market. Just like if you were to flip the coin 100 times, we would have a very strong or high confidence in saying that you'll get 50 heads and 50 tosses, plus or minus 5 on either side. So maybe you get 45, 55, at worst case 40, 60. It's still quite in the ballpark. But in one coin flip or 2 coin flips or 3 coin flips, it could be all heads, all tails, tails, heads, tails, heads, heads, tails, any kind of combination, and nobody has a clue on that. So similarly, in the longer term, reasonable to expect, as has been the evidence, empirically speaking, worldwide, be it in the developed economies of the West or even in India, over the last 30 years, nominal GDP growth rate has been 12%. Corporate earnings growth has been 12% on the back of the 12% earnings nominal GDP growth rate. And returns from the equity market has been 12% as well, as Dipujal just pulled up this chart, you'll see it does not come in a straight line. Nominal GDP growth is the most predictable or closest to the straight line, right? It has varied from maybe mid-single digit to mid-teens over this time with an average of about 12%. Earnings is then the second most predictable on back of nominal GDP growth. As you will see, over the last 30 years, it's ranged from about 45% earnings growth from 93 to 96 to flat, just 1% earnings growth from 97 to 2003. And then 25% CAGR from 04 to 08. And then mid-single digit from 08 to 20. And then last couple of years has been 20+% CAGR. So earnings is much less predictable than the nominal GDP, and obviously the market, which also adds the layer of the multiple, because a multiple applied to the earnings is the level of the market, and the multiple is the most volatile element, and hence you've had over time period markets go down 50-60% as well, like in 2008, in any given short period of time, like a year. But over time, over this various years, I'm sure you've all seen social media messages on how 70% or 80% of the years the market has delivered positive return. But I think going forward on an expected basis, reasonable to expect that, as it has happened in the past in India and in many other countries, and there's logical reasoning behind it, that returns to be that the returns that the Indian equity market would deliver would be in line with nominal GDP growth rate, which is low double digit, 10%, 11% or so. We as a team obviously strive to do a lot better. Our internal targets for alpha are fairly strong and high expectations from our team. So the total return that an investor can generate can be this market return plus the alpha generation over a reasonably long period of time. In the near to medium term, it is completely impossible. It's not just very difficult to predict, it's impossible to predict. You can throw in whatever variable you like, the Fed, the inflation, the rotations, the valuations or whatnot. I will just request you all to take the time, 10 minutes, to read our 2020 newsletter, which was published in January 21, which is a year ago, and it would address all those questions. And if after that you still have questions, happy to, our team would be happy to address those once again.
No, sure, Prashant. You have, of course, set very exacting standards. There are very few managers who had that level of outperformance over, from the time White Oak has been set up. You've outperformed each one of those years. So one of the questions which I would rephrase out here is, in markets like this, is there more emphasis on managing risk rather than looking at returns?
I think there's always an emphasis on managing the risk. The way we think of risk is in terms of relative performance. So the market risk, as I just said, if it's impossible to time the market, to predict the market, whether it's going down or up, we are not trying to even in any ways predict that risk or manage against that risk. This is a decision that is best taken by the investor who's investing money in coordination with their financial advisor on how much risk that they tolerate. But once you've decided for the portion of your wealth or your net worth that you've decided to take equity risk, we will provide you that risk. And as I said, nobody in a coin flip, nobody has a better idea, be it Warren Buffett, or be it the lay person walking on the street, or be it Virat Kohli or Rohit Sharma at the start of any cricket match when they're flipping the coin. Nobody has any advantage over any other human being or animal when it comes to coin flip. And same is true for market timing. So it's not that many people think, oh, the fund manager can manage this market risk better than us or the financial advisor or something. There's no such thing with a coin flip, and hence there's no such thing in the market. You decide how much risk you want to take in your overall net worth or portfolio that is tied to equity market risk, and we would work with that. We would not amplify that, we would not mitigate that. What we think of in terms of risk is relative to the equity market. We should not have any systematic or stylistic risk which prones us to underperformance in certain market environments. It is never possible to zero out such risk, but our portfolio construction framework, which is a balanced portfolio construction that I talked about, that helps us to be focused on this aspect of the risk and mitigate it. And that has been the reason why our team has generated as consistent outperformance. Because the very few managers, I'm not saying no one else, but there are very few managers whom you would find outperforming during 2018-19, which were very difficult years for fund managers, particularly in PMS and AIF, who invest in mid caps and small caps, and then outperforming in 2020 as well, and outperforming in 2021 as well. Most of the time, you'll find that those who outperformed in 2021 are quite likely to have underperformed in 2020, or vice versa. Or more confidently, I can say most of the managers who outperformed in 2021 would have underperformed in 2018. Very few managers would have outperformance in both 2018 and 2021. And that is, our team has been able to deliver that because of the focus on this portfolio construction and risk management relative to alpha generation.
No, great. Thanks, Prashant. I guess the salient feature around the balanced portfolio construction is something which really distinguishes White Oak from a lot of peers which we have. As Prashant rightly said, if you had to see some of the best sectors which did well, as from a market perspective, we actually had very little allocation in many of those sectors. And despite that, the team at White Oak has been able to deliver that type of outperformance because of the construction which we've had. Prashant, I'll come to you again, but there's this thing which a lot of people are asking about technology, considering Ayush just made this presentation, Ramesh. So, technology is a space which you see very closely. The timing of this digital leaders portfolio, with the amount of volatility in the tech market globally, and also, this type of valuations which one is seeing of this whole new age tech companies. I know, again, as Prashant rightly said, we don't time markets, we don't take cash calls, we don't have any of those type of macro overlays which are there. But how would you look at a strategy like this in times of today?
Yes, as Prashant said, predicting the performance of even a digital or technology sector on a one-year basis is again like flipping a coin, right? One thing is kind of having seen the experience all over the world, whether in US markets or in China, that over longer time periods, and what Ayush had demonstrated, that companies which are digital leaders, innovators in using technology tend to over longer term outperform the market. That doesn't tell you anything about what happens on a one-year time horizon, because that is like flipping a coin. However, you understand that when you compare, if you look at the performance of Indian IT sector, I would say it's been pretty resilient versus when you compare what has happened in NASDAQ in the global technology sectors. If you look at, if you kind of ignore the FANG stocks, the top 5-6 stocks in the NASDAQ, there has been a large correction in the technology names. But those companies are often very different from what you largely have in the public markets in India. The technology sector in India comprises of largely IT services companies and some software companies. Those businesses are exceedingly profitable. As of now, just about every company in this earnings quarterly call has called out the problem is supply, not demand. Unlike a lot of companies on NASDAQ, which are loss-making, business models are evolving. And even what we have invested, even in the new age business models, In fact, surprisingly, some of the most profitable companies in the market, I'm talking of top decile in terms of margins, also come from new age business models, right? And those some of those many of those companies are in our portfolio. So I want to say one thing is, one, it is not possible to predict in the short term what happens. The long-term opportunity, in our opinion, is there. And Indian market mix is very different from what we're trying to compare globally in tech. And number three, it is, our ability, which we have demonstrated, and the capabilities we're building, that we believe we are best positions versus our peers to deliver, alpha, market leading alpha for our clients.
Oh, great. Thanks, Ramesh. Also, as Ayush did mention, this is it is in a way a subset of what we do when we talk about balanced portfolio construction. There are three themes playing out there. It's not just new age tech. We've looked at companies from IT services and companies which are providing the backbone for the whole technology build out, or digital build out of tomorrow. We're looking at the new age companies, and we're also looking at incumbents which are digital leaders. So a balanced portfolio among this is something which we believe will provide a lot of stability to the portfolio. The way we've been doing that on the Pioneers portfolio. Prashant, one of while the whole Ashish did lay out the blueprint of what we are building out on the asset management company side when we launched the mutual fund business. And there is, a lot of people are excited about that, but there is also concern from many of the existing PMS investors. Are we overextending, or is our bandwidth going to get extended? We've also grown quite rapidly as a team. Just from an asset perspective today, you mentioned right at the beginning, we're at about $6 billion, 45,000 crores. The mutual fund business hopefully is going to double this. Beyond that, we will continue to focus on the PMS and AIF side. Are the Indian markets deep enough to be able to take meaningful positions as we build this portfolio out? Is the investment team well capacitized? How are we going to balance our mutual fund and the PMS AIF business?
Certainly. No, good question. Very pertinent question. And at least the question goes to show that you can send any question that you have in mind, easy or difficult for us, and Prateek would read it out. So this is a very deep question that requires some amount of time for discussion. So I'm going to say in brief few things, but happy to go into greater detail if follow-up questions are there. So first of all, let's be very clear, all else equal is the underlying word. For any given manager, there is a certain optimal capacity that they can work under. Now, this can vary from manager to manager, depending on various aspects of how the investing is done, what is the investing approach, and how things have been structured. We have structured, and I'm going to go into those aspects in a minute, but we have from day one structured to be able to manage at large scale. It's partly to do with my experience at Goldman, where obviously Goldman does not start a business unless it can be built to scale, and you have to demonstrate. So when I moved to India in 2007 or 2006 to start and build Goldman Sachs in India, I had to demonstrate that would build a business so as to be able to scale it up to $10 billion. And the reason $10 billion is kind of like a minimum desirable number is because $10 billion was result in $100 million of revenue, more or less at the time we thought at 1% using offshore and domestic. Offshore there tends to be higher fees, domestic maybe somewhat lower, but about $100 million business, which is kind of what would be acceptable for a global MNC firm to have a local presence in a country like India, let's say. So the business was being built there to be scalable to $10 billion back then. I'm talking about a decade ago. When I left Goldman 4.5 years ago, across GEM, we were managing $6.5 billion, nearly half of which was invested in India. And remember, this is nearly 5 years ago. Since then, the markets have more than doubled. Liquidity in the Indian market has tripled. So it's like managing nearly $10 billion, equivalent of today, nearly $10 billion back then, when you think of the liquidity of the markets and the market cap of the market today. So building from day one, the aspects of the business which can scale up to much larger level is an important part, which not all managers do. What a lot of managers do, they start in a manner that is conducive to manage a couple of $100 million. And when they grow larger, they change or try to change and don't usually change optimally. So what are some of these aspects? And in no particular order of importance, I would say. One, portfolios that are concentrated portfolios, owning 10 names, 20 names or so, have lower scalability than portfolios that have larger number of names. Okay, and with a lot of you, I've gone into extensive discussions about why we believe having larger number of names provides opportunity to generate higher alpha. It's not about risk diversification, but it is about higher alpha. And that is why we have larger number of names. Larger number of names also builds for higher capacity. And it's everything else has to be again designed according to that. You can't have a large number of names like we have in the portfolio, more than 50 names, run by effectively one decision maker. So many teams, that brings me to the second point. Teams that are run by one decision maker predominantly, say small teams run by predominantly one decision maker, is not as scalable, optimally scalable. So would hit a alpha headwind at much lower AUM base than a team like ours, which is one of the largest and most well-resourced team in the industry, more than 20 people now and growing, and is very decentralized from decision making. So that is very important aspect to be kept in mind when you think of capacity that a team can manage. Third, say the construct of the portfolio itself, where how are you position sizing? Are you, again, larger number of names allows you to size these small cap positions smaller, which is the constraints, capacity constraints lie at the small cap level. Small cap as of today, as per SEBI, going by SEBI's definition, is about 1.8 billion or so, about 12 to 13,000 crores, somewhere in that range, right? So anything less than that is what poses capacity constraints. So if you are managing a concentrated portfolio with equal weights across companies of, let's say, 10 name portfolio of 10% each or 20 name portfolio of 5% each, then it would pose a constraint where you cannot buy at larger AUM sizes 5% position in small companies. And you anyways can't increase the number of companies in your portfolio because you have a small team and one or two decision makers who are effectively running the portfolio. So there's a limitation of how much that is the bandwidth for these individuals in terms of number of names in the portfolio. So having the flexibility of owning large number of names right from the start, how we structured it, having a large team that allows proper detailed coverage of this large number of names in the investable universe as well as in the portfolio, having a decentralized decision-making framework, all these help in maintaining the alpha potential at higher levels of assets. And we have further continuously invested in building the resources on our team. When we started, we were a 9-member team. As I said, today, we are more than 20-member team. Obviously, most of the original team members are still there. So the average experience of these senior team members is also higher, though we have now the entire, in each sector, multiple member teams that is very, very experienced. So these are some of the aspects. Furthermore, the mix of your assets in terms of how much is daily liquidity, how much is closed-ended funds. Like we have several AIFs which are closed-ended. So if you have everything in closed-ended funds, then the capacity is higher than if you have everything in daily liquidity funds. We have a good mix of daily liquidity funds as well as closed-ended funds. Furthermore, the mix of underlying assets by client type, whether it is all retail individuals or there are also institutional investors. Institutional investors tend to obviously tend to often have longer stickiness and investment horizons. So we have a very good mix of institutional investors. 40% plus of our investors are institutional investors, the largest sovereigns and pension plans. And on the retail side, we have several funds which are closed-ended funds. So all these things put together, and I'm happy to go into greater detail, means that there is a lot more capacity still left. There are people out there, fund managers out there who run north of $10 billion, close to $15 billion. We are currently $6 billion. So there is, and we have designed from day one in a framework which allows for scalability to much greater level than what other people have designed their businesses. So as of now, we are not running into that headwind. But if we remain very mindful and continue to monitor that, if we see that, we would take adequate precautions and be willing to make course corrections to maintain the alpha potential.
No, great. Thanks, Prashant. I think this is fairly exhaustive. As Prashant has always had maintained, even in his presentation, there are very few managers who are alpha focused, and the entire team at White Oak, takes that as a very core responsibility to ensure that through the design of the portfolio, the alpha is generated across different sectors. There are a lot of questions which have come around the whole digital portfolio. So I'll just summarize some of the points out there. One is, there is a question around timeframes, right? When, Ayush did mention this and Ramesh reiterated the point that this is a decadal opportunity, right? We've spoken about how India is on the cusp of the same revolution which you've seen in some of the other markets around the world. And in a way, you will see trends grow stronger out here. The market cap of some of the new age companies is more like 2 to 3% right now. And we expect that to go to 25-30% over the next few years, over the next decade or so. And I guess the time frame for being in a strategy like this is where you would need to ride it through that particular period. Does it mean that this is a riskier portfolio than some of the and that's the other point which people are asking about. And I guess one has to look at it as a more satellite thematic portfolio where your multi-cap portfolios tend to be your core portfolios. And these are portfolios which do tend to add diversity. But the best people to advise you would be your financial advisors in terms of what type of proportion should you have an allocation to a strategy like this. Ramesh, just taking from what Prashant did mention about the construction of the team within the mutual fund business versus what we're doing within the PMS, AIF piece. How are you looking at initially the team building out within the mutual fund piece which you would lead?
Oh, thank you, Prateek. So one, we have, within the, White Oak Group, tremendous access to research resources as one of the most, deeply resourced, risk investment teams. We are also, building, we're constantly growing the team. So we will be adding more members to the team, clearly, and we are also planning to launch under the AMC umbrella, the Global Emerging Markets product, which we will launch in a few months' time. We are, building a team of, experts who have a lot of experience of investing in a lot of countries outside India, including markets like China, Taiwan, Korea, parts of Asia, LATAM. So we're building a deep, bench of talent in the next few months. and we will launch the product calling. And also a number of team members also have experience. Currently, even the team also have experience of investing, globally. So there is going to be a cross-pollination of, there are people who are going to cover the same sector globally within White Oak, in the sense, let's say some sector has inherent characteristics of being covered more at a global level, something like commodities. And then there are sectors which you have to have very local expertise, for example, utilities, right? And then there are sectors where there is, teams have to work very closely coordinated to cross-pollinate learnings. At the same time, you get local expertise. For example, India Internet or India Tech, you can learn a lot from what has happened in emerging markets across the world. But at the same time, you have to have a deep India context to identify opportunities. So we have one of the most well-resourced team, and we are expanding on the team as we speak.
If I may add, am I audible?
Yeah, Prashant.
So if I may add to what Ramesh said, we have currently nearly 25 people team across research and trading across the group. By the end of the year, quite likely this number's to be again. The bottleneck is just ability to find talent, which is a good fit for our team, the way we approach investing. But I expect, going by past trajectory, we should be somewhere about 35 to 40 member team across the group. Majority of it would continue to work on India business, India ideas, and collaborate very closely with the non-India team as well. So China and rest of the emerging markets. Research and investment team is at the core of delivering. Performance is only as good of any sports team or investment team, is just as good as its team can deliver. So we would make sure that there is at all times all the resources made available, and it remains the most well-resourced team in the industry. The same investment team or the research team would be feeding ideas, generating ideas for the different pool of assets that are investing in India. The fund manager could be different, but it is the driving force, which is the research team, would remain the same, as is the case with other AMCs as well, who have fund management as well as PMS as well as offshore funds.
No, great, Prashant. I think you've taken the Make in India mandate to the asset management company industry, where I guess the makings of a global asset management business making it from India. So with the size of team which you've said, and the resourcing across this, everything points to that. That sounds great. I've got a couple of last two questions on this before we end. One, Ramesh, maybe to you first. The FY22 earnings have thrown positive upsides. Just going back to the market part of it. Are we seeing similar type of trends play out in this financial year? When we look at various sectors right now.
Sure. I think, Prateek, when you think about earnings surprises, I think the sheer surprise was FY21, actually. When you think India's economy, GDP declined by 8%. That's the worst since 1980. For the first time, India's GDP declined. And then, it was the highest ever decline we ever had. And in that context, we had corporate earnings growth of 14%. This year, of course, because there are a number of trends at work in the economy, you are seeing a consolidation, in market share from unorganized to organized sector. That's a major trend that has been playing out. And we are seeing that play out in a lot of sectors, in building materials, consumer staples, even in retailing businesses. That's one major trend that's been driving, where the strong companies are emerging stronger across industries. There's, of course, the trend on China +1, where a number of Indian companies are benefiting from the challenges a lot of companies have faced because of supply chain challenges in China, and the fact that those challenges still continue there is now significant focus to diversify and create a separate supply chain. And a number of companies, whether in specialty chemicals or even electronic manufacturing, are doing well. And of course, the two sectors, that have done well and are sort of beneficiaries from the pandemic is technology services and pharma. Those within that different company, IT services particularly has done exceedingly well. And Ayush had talked about the acceleration of digital adoption. We are also seeing after many years, maybe 5+ years, a very strong real estate sales across the country. And we have already seen in the last 5 years significant consolidation in the real estate developer market. And now again in that space, real estate sales are very strong, maybe because of work from home, people want a larger house and people have saved money. And of course, in a lot of sectors, there's huge salary increases, particularly in IT and all, and people have a lot of confidence in the future. So real estate has started doing well. And of course, metals and some of the commodity sectors, have done exceedingly well. So it looks like, and of course, one of the sectors that there has been a lot of concerns about earnings and the ongoing impact of pandemic. We would say that the private banks have done an exceptional job of maneuvering their balance sheet in the crisis. And I think a large part of the pain of the pandemic is behind, particularly for the strong, well-run private banks. And so I think overall, there is a good amount of confidence across sectors, and it seems to be a lot more broad-based. When I speak to people, even in the infrastructure and industrials, even in industrials, a lot of industrial sector, which was struggling for a decade, is calling out for all-time high orders. Similar is the trend in infrastructure. So there is, a lot of more, I would say, bottoms-up confidence in the demand environment. Of course, there is some concerns because of the inflation in certain commodities. And of course, the ongoing disruptions that continue in supply chains. For example, auto sector continues to struggle with the semiconductor shortages. It's getting better at the margin. So I would say overall bottoms up, I think, across sectors, I think demand environment is good, considering what we have had in the last 5 years. I think bottoms up, the public markets represent the strongest companies in the economy. That is by design how public markets operate. And they are gaining at the cost of, smaller peers, unorganized sectors across the board. So I would say bottoms up, I think the trajectory is good, for earnings, and there's no reason to, I think the pain earlier that used to come from commodities and financials, particularly PSU banks in the corporate loan books, that is large part of that. In fact, commodities are doing exceedingly well, and large part of the pain in the corporate loan books has been kind of over largely. So there are less detractors and more positive additions. So it's likely that the corporate earnings trajectory will remain quite strong.
Great. Thanks, Ramesh. That sounds nice and optimistic. Prashant, the most hackneyed question you always hear, typically from a lot of media, people very close to the budget, right? And which is also a question which is asked out here. So I thought, our topic cannot end without what are expectations from budget. And I know you've been asked this a lot of times.
I think right now probably this been asked so many times in media that at the risk of repetitive, I think, see, first of all, budget, unless it's something very dramatic, extreme, tends to have very short-lived impact, positive or negative. That's one. But it is, to some extent, a important point in the year, determinant scheduled point in the year where you get a sense of what's the intent of the government over time. Now, this time coming right in front of the election season, UP election is the second most important after this central election. And election season would be starting with UP election, because then later in the year we have Gujarat election, and then within 2 years from UP election you'll have central election. So we are not expecting anything that would be unpopular on the surface. We are expecting some popular initiatives. And when we say we, it's probably in general, same is true for investment community. What we would hope is that along with these populist measures or announcement, the government continues with some even renewed vigor along the lines of ease of doing business or ease of living. India has improved from 132nd rank to 63rd rank over the last 7 years. And I keep saying and repeating that in the game of cricket, we all feel terrible if we are second. If we qualify for World Cup final and lose it, we'll be basically second, but we'll all feel terrible. We don't want to be second in cricket. We want to be number one in cricket. Then something like ease of doing business, which is at the core of livelihoods, because the easier it is to do business, the more businesses would be set up. It doesn't matter whether domestic entrepreneurs set up or foreigners come in, bring in capital, expertise, know-how to set up companies. They'll generate more jobs, make the economy more competitive, increase exports, and just a virtual cycle that gets established. Obviously, it all generates a lot more cash flows for the government in terms of taxes. The government can redeploy them in social welfare schemes and education and infrastructure and whatnot. Making it easier to do business is one of the simplest, I think, most straightforward thing, and it can be done in a manner that is not unpopular. There are thousands of things that can be done in a manner that are not unpopular. In fact, they can be spun to have a popular twist as well. And our hope is we'll see a good dose of that. I've used the word our hope because I think at this time it's reasonable to expect that the focus might be on some of more populist schemes in this year and next year's budget. But that's how democracies everywhere in the world
But having said that, Prashant, despite a lot of pressure, our government has been very, right on fisc, right? I mean, they've been able to navigate this.
That has always been the hallmark of, I would say, BJP government, this government, and in the 99 to 2004 as well, that the focus on fiscal is always there. Even with the pandemic, there were a lot of calls. Yeah. And our team has been on the record on TV as well. We were never supportive of major government giveaways, tax giveaway or otherwise grants and whatnot during the pandemic. The government remained quite tight-fisted through the pandemic. They did announce things, but ultimately what flow actually came out from budget giveaways was fairly small. And thankfully, because money doesn't grow on the trees, anything given away by the government has to take back from somewhere or the other. Higher taxes is usually what they deploy, and that's not the best for the economy over time, to have higher taxes and then spend it away. I think the government has done a very reasonable job, and I don't expect any surprises there.
No, sure, thanks. I mean, this combined with the soft infrastructure, which Ramesh did mention earlier in the presentation, which contributes to the whole India premium story, I guess are some of the redefining factors, right? So if you had to look at the scenario today, while, maybe we may be talking in a week where the markets have, mildly caught cold figuratively, as a lot of people have. The longer story, which Ramesh did allude to from an earnings perspective, the overall, the feel-good factor from an India perspective, I guess points to the fact that we continue to hold fairly strong domestically at this point of time. With that, we will really wind up this particular session. You would continue to hear a lot from White Oak going forward. Ashish did talk about launch of. Sorry, Prashant, you had to say.
Say that I noticed many more questions that we haven't been able to cover on this call, and apologies to them. Prateek has tried to cover as many, but hopefully we can address those on some other forum or in some other manner through the financial advisors. Sorry, Prateek.
No, we'll do that, Prashant. And as I said, we will also be reaching out to people as we launch our mutual fund bouquet and reach out to investors, distributors, and the larger audience. You will keep hearing and seeing a lot more of us. And thanks everyone for the support which you've given in this last 4.5 years of journey. And I guess watch the space for White Oak as we emerge in a new avatar with the launch of the mutual fund business. So thank you, everyone. And thanks, Prashant.
To all the investors and clients for your support and trust you placed in our team. Thanks again.
Thank you.
Have a great weekend.